Welcome to video 7 of part 1 of the EA Tax Training free EA exam prep course for 2026. Tom here, back with you to discuss specialized returns and topics. Specialized returns is a phrase borrowed from the IRS testing outlines. Essentially, what this video covers is all the miscellaneous individual tax topics that don't fit neatly into any of the other categories. Specifically, what we'll cover in this video are amended returns, foreign income and accounts, rental real estate, household employees, marriage and divorce, estate and gift tax, and finally, tax planning. Our free resources from irs.gov. Since we're covering so many topics, we've got 2 slides worth of resources in this video. Of course, we've got publication 17 and the instructions to Form 1040. Then also we've got Form 1040X and its instructions, and Form 2555 and its instructions, with several other forms that are related to foreign income and account. Another of those that is highlighted is the FBAR, otherwise known as the FinCEN Form 114. You'll definitely want to get that one and check it out. Then we've got publication 527 for residential rental property, Schedule H for household employment taxes, along with its instructions. Then the other 2 in bold down here are Form 709, which is the gift tax return, and Form 706 for estate tax. Let's start by talking about amended tax returns. If you discover an error and want to amend a previously filed 1040, you do so on a Form 1040X. Anytime you see the X at the end of a form number, that signifies that it is an amended return. You must, of course, file the original return before you can file the amended return, and you can file more than one 1040X for any given year. There is no limit on the number of amended returns that you can file. If you find a mistake, you can file a 1040X. Find another mistake later, you can file another 1040X without limit, as long as you do it within the time period that is allowed, that we will be talking about. You don't always have to file an amended return. If you file your return early, before the regular due date, and you notice an error before that due date passes, you can just file a new Form 1040. It's called a superseding tax return. Now, once April 15th is passed, then you're going to have to file an amendment. This can be a nice way to avoid an amended return. Let's say you file a return on March 1st, and then before April 15th, either you or the client notices that there was a mistake. You can just file another 1040, and in your software, there should be a box that you can check to indicate that it is a superseding tax return. Then you can file that. It should go through electronically, no problem. Then the IRS will just use that as if it were the originally filed tax return. But once April 15th is passed, you are going to go on to the amended return. So here is what the 1040X looks like. Let's zoom in. It's going to have all of your standard information at the top. Then down here in the heart of the form is where you are going to show the actual changes. So what you're going to do is, for any line that has a change, you don't have to necessarily fill out every line, but for any line where there is a change, you're going to show the original amount that was on the original tax return. Then you're going to show the correct amount over here in column C, and then column B is the change. So it's the difference between the original return and the corrected amount. You're going to go through that and do that for every line that changes. Then you'll go on to page 2, where you'll see dependent information. So if you're adding a dependent, removing a dependent, anything like that, any changes for dependents will go there at the top. Then you do have part 2, which is an explanation of the changes. So you do have to put some sort of explanation. Doesn't have to be long, but you need to explain what you're doing. Also, you will want to attach any schedules that might be changing. So for instance, if Schedule B is changing for interest and dividends, you would put the new Schedule B with the 1040X. Or maybe you got an additional K1 from a partnership. You would put Schedule E to show that K1. So any forms that are changing you want to attach to the 1040X as well. Then you're going to get to the bottom, and there are the signature blocks. Again, the taxpayer and you as the preparer are signing under penalty of perjury that everything on the return is correct. In order to amend a return, you must generally file it within 3 years of filing the original return or 2 years of paying the tax, whichever is later. Now you say, don't you usually pay your tax when you file the return? Well, yes, usually, but that's not always the way it works out. So you always have to keep in mind both dates. If you are amending the later of 3 years from when you filed or 2 years from when you paid the tax. If you filed the original before the original deadline, the return is considered filed on the deadline. So if you filed on March 1st of a particular year, that return will be considered filed on April 15th. So in other words, if you filed your 2025 return on March 1st of 2026, you have until April 15th of 2029 to amend that 2025 tax return. If you had gotten an extension to file after April 15th, so you got it extended to October 15th, but then you filed, let's say, on July 1st, then you use the date actually filed. So then it would be 3 years from July 1st. There are times when you get more than those 3 years in order to amend your tax return. If the taxpayer is physically or mentally unable to manage their financial affairs, they can have more time to amend. If you're in a federally declared disaster area, you'll often get an extension of time. The IRS will announce that. If you were serving in a combat zone or in a contingency operation, as declared by the president, you get more time. And then these last two, you will definitely want to know for the exam. The reason you are amending is due to a bad debt or worthless security. You have 7 years after the due date of the return for the year that it became worthless. So sometimes with a bad debt or a security, you won't know that it became worthless until you've got hindsight to look backwards and say, hey, you know what? As of that date, there was no way I was ever going to get this money back. If the reason you were amending was due to a foreign tax credit, then you've got 10 years from the original due date of the return to amend that return. So if you're amending your 2025 return for a foreign tax credit, you've got until April 15th of 2036 in order to amend that 2025 return. So remember those 7 and 10-year exceptions for the exam. We know that you have the later of 3 years from when you filed your return or 2 years from when you paid your tax to amend your return. But how long does the IRS have to go back and audit your return? Well, the IRS has 3 years from the date due or filed, whichever is later. So again, if you filed on March 1st, they've got 3 years from April 15th in order to audit your tax return. Unless you omit more than 25% of your income, in which case they've got 6 years instead of 3 years. Or if you commit fraud, in which case there is no statute of limitations. Or if you do not file a return, then there is no statute of limitations. The statute of limitations does not start until you file the return. So if you never file the return, the statute never starts. Therefore, they can always go back and look at it. So remember all of these rules. We're going to get more into this in part 3, but just remember 3 years from the date due or filed. But you do have these exceptions. If you omit more than 25% of your income, even if it is inadvertently, then they have 6 years. If you commit fraud of any kind, then there's no statute. They can go back for 20 years if they want to, if you committed fraud. And similarly, if you didn't file a return 20 years ago, they can still go back and look at that year. There is no limit in those cases. One interesting thing that a lot of people get confused about is filing an amended return does not extend the statute of limitations for the IRS to audit the original return or that amended return. So let's say, for example, you had a 2022 tax return. The 2022 return was due, I believe it was April 18th of 2023. But in any case, the idea is the same. So that means the IRS has until April 18th of 2026 to audit that 2022 tax return. Let's say you amend that 2022 tax return in January of 2026. How long does the IRS have to audit that amended tax return and the original return it was based on? They have until April 18th of 2026. So even though you just filed that return 3 months before the statute of limitation expires, it does not change the statute of limitations. The one exception is if you file the amended return less than 60 days from that statutory limit, then the IRS has 60 days from the date filed. So if you didn't file that amended return until April 1st, for instance, then they would have 60 days from April 1st in order to audit that return. But still, that's not a lot of time, but that is the way it works with an amended return. Sometimes you do not need to amend a return if you are filing for a refund for a specific purpose. So you use Form 1045, application for tentative refund. So first of all, it does have to be a refund. And if you are filing for a refund due to any of the things on the slide here, if it is for a net operating loss carryback, if it is for a general business credit carryback, for a Section 1256 contract loss carryback, or for an overpayment of tax due to a claim of right adjustment. If you have any of these things, you do not have to file a 1040X. Instead, you can file this Form 1045. And at least theoretically, you should get your refund faster than filing the amended return. Moving on to our next miscellaneous specialized topic, foreign income and accounts. Remember that U.S. citizens and resident aliens must report all of their foreign income, whether earned or unearned. Of course, they have to report all of their income, domestic and foreign, but right now we're dealing with the foreign income. If you live outside of the United States, it's possible that part of your earned income may be able to be excluded from your income on your tax return. We'll be talking about that. If you paid foreign taxes, you may get a credit against your U.S. taxes. We'll talk about that as well. And finally, if you had foreign financial assets like bank accounts and brokerage accounts, you may have extra filing requirements. So let's talk about each of these things. Foreign earned income on Form 2555. We have already referred several times throughout this course to the foreign earned income exclusion on Form 2555. You'll recall we've had credits where we said you can't take this credit if you file Form 2555. We've had adjusted gross income where we said you have to use modified adjusted gross income, which means adding back your excluded foreign earned income to your adjusted gross income. So now finally we're getting to this explanation of this excluded gross income on Form 2555. So again, U.S. citizens and resident aliens, no matter where they live, must report all of their worldwide income and file a tax return, assuming it is within the normal minimum income requirements. If you live in a foreign country, you may be able to exclude your earned income up to $130,000 per person in 2025, and that amount does go up each year with inflation. Even if you do exclude that income, you have to file a 1040 even if all of your income is excluded. So let's say your only income is from a salary, you live in a foreign country, and you have $120,000 of salary. So all of it is excluded. So you have zero adjusted gross income. You still have to file a 1040 since you excluded that income. Then you would also attach the Form 2555 to the 1040. In addition to excluding that earned income, you may also be able to exclude or deduct housing costs of up to $39,000 in 2025. So we will talk about that. And then very importantly to keep in mind, these rules do not apply to U.S. government employees or to members of the military. So this is going to be people working for private companies and organizations. In order to qualify for the earned income and the housing exclusions, your tax home must be in a foreign country, and you must meet either of these two tests, the bona fide residence test or the physical presence test. So you have to have both of these things. Your tax home is in a foreign country, and you meet one of these two tests. So first, your tax home. In order to qualify, your tax home must be in a foreign country throughout your qualifying period. Usually, this is where you have a permanent or indefinite work assignment as opposed to a temporary one. So, for instance, if you work for a US company and they say, hey, we're going to transfer you to Mumbai, India, that's where you are going to work now. So, that is your permanent work assignment. Mumbai would then be considered your tax home. Or if they sent you on an indefinite work assignment, so they said, we need you in Mumbai. We're not sure really how long it's going to be. We've got this big project. You're going to be there until that project is completed, however long that takes. That is an indefinite work assignment. So your tax home again would be in Mumbai. But if they say, hey, we're going to send you to Mumbai to work for 12 months and then you're going to come home, that is a temporary assignment. So your tax home would not be considered Mumbai in that case. In addition to working for someone else, this could be in your own business as well. If you establish your own business in that foreign country, then your tax home would be in that foreign country. Once you have established that your tax home is in a foreign country, then you have to pass one of those two other tests. The first of those two tests is the bona fide residence test. For the bona fide residence test, you simply need to be a bona fide resident of a foreign country for an uninterrupted period that includes the entire calendar year. If you are a U.S. resident alien rather than a citizen, then there is one other requirement, and that is that the country of which you are a citizen has a tax treaty with the United States. That doesn't mean that the country that you are a bona fide resident of has to have a tax treaty with the United States. It means that the country that you are a citizen of has to have a tax treaty with the United States. So if you are a citizen, for example, of Spain, and you are a bona fide resident of Venezuela, what is important is whether or not Spain has a tax treaty with the United States, not whether Venezuela does. So as long as Spain has a tax treaty with the United States, if you are a bona fide resident of Venezuela, then that would count for this test. So how do you know if you are a bona fide resident? Well, that is going to depend on the facts and circumstances, such as the nature of the job assignment, setting up a permanent place to live, etc. Just living in a foreign country for a calendar year does not automatically mean you are a bona fide resident. So first of all, remember, no matter what, your tax home is going to have to be in a foreign country. Then in addition to it, you're going to have to be a bona fide resident. So they're going to look at all the facts and circumstances to determine if you meet this test. The next test you can pass, in addition to having your tax home in a foreign country, is the physical presence test. So for a U.S. citizen or resident alien, if they are physically present in a foreign country or countries for at least 330 full days during any period of 12 months in a row. This can span over 2 calendar years, and the exclusion then is prorated between the years. So, for example, if you were in a foreign country or traveling between foreign countries from August of one year through July of the next year, as long as your tax home is in a foreign country, then you would meet this physical presence test. The big difference with the bona fide residence test is it does not have to be for the entire calendar year. It can straddle years, and then you prorate the exclusion between those years. Next, let's talk about that foreign housing exclusion. If you are provided a housing allowance by your employer, you can exclude up to $39,000. Now, the amount may vary depending on location. The IRS does have a list of countries and how much this exclusion is. It can be more than this in some higher cost countries, but the number you want to remember for the exam is $39,000 that you can exclude. If you are self-employed, then of course nobody's going to be giving you $39,000 to exclude, but you can deduct up to $39,000 of qualified housing expenses. And again, that $39,000 might be different in different countries. In order to take these exclusions, either the foreign earned income exclusion or the housing exclusion, you have to make an election to exclude that income. The way you make the election is by filing this Form 2555 and excluding the income or housing on your tax return. Once you make that election, it is effective until you revoke it. So if you make that election by filing Form 2555 in 2025, then you're automatically also going to be excluding your income in 2026 in future years, unless you revoke it, which you can do. You can take it 1 year and revoke it in the next year, for example. However, once you revoke it, you cannot take the exclusion again for 5 years. Now, you might be asking a question, why would you not exclude this income? Isn't it going to be best to exclude the income? Then you don't have to pay any US tax on it? Well, not necessarily. And that is because there is an alternative. The alternative is to take the foreign tax credit, which we will be talking about next. Taking the foreign tax credit may accomplish the same thing. It's just going to depend on all of the circumstances. The other reason that you might want to not exclude your income is because excluding your income can affect other parts of your tax return. As we've gone through the course, we've talked about all those places where if you file a 2555, you cannot do this. Or when you're looking at adjusted gross income levels, you have to use modified adjusted gross income. Modified adjusted gross income, no matter where it's used, you have to add back any foreign earned income that was excluded. So it can affect all of those items. So for instance, if you exclude your foreign earned income, you cannot take the child tax credit. You cannot take the earned income credit. You can't take the foreign tax credit for the amounts that are excluded. You can still take the foreign tax credit for other amounts, but not for the amounts that are excluded. And if you're making IRA contributions, they may be limited because of that definition of modified adjusted gross income. And there were other places in the tax law where this applies as well. So you have to look at the taxpayer's individual circumstances to see whether or not it is best to exclude that income. So now let's talk about that foreign tax credit. If you pay income tax to a foreign country, you get a credit against US taxes within certain limits. The foreign tax credit can be used for taxes on both earned and unearned income, and you report this on Form 1116 foreign tax credit. If all of the income is passive or investment type income, then usually you do not need to actually file the Form 1116. You can just take the credit on your return. If you have an excess tax credit that you can't use all of this year, it's not refundable, but it can be carried back 1 year or carried forward 10 years. So remember that for the exam. Excess foreign tax credit can be carried back 1 year, forward 10 years, which means you can amend your previous year's tax return in order to take the foreign tax credit if you want to. Then also you need to know for the exam that you can deduct your foreign income taxes on Schedule A as an itemized deduction if you want to, but it's almost always going to be better just to take the credit. Remember, we said a credit is a dollar for dollar reduction in the tax. So that is almost always going to be better than just taking a deduction, though there could be some rare cases where it works out the other way. So in the real world, you're not going to probably do this. However, for the exam, you should know that you can deduct it on Schedule A or take the credit. You have the option. Also, if you exclude your earned income, you may still have some foreign tax to pay. So you may still be able to take the foreign tax credit. You cannot take the foreign tax credit for the amounts that you excluded. So that foreign country taxes you on your earned income, and you exclude that earned income for US tax purposes. You could not take the foreign tax credit on the amount of tax that you paid on that income. However, if you paid a foreign tax on other amounts, so let's say you excluded $130,000 of salary, but your actual salary was $150,000. Well, you can take the foreign tax credit for the amount of tax you paid on that extra $20,000. Or if you had interest, dividends, etc., that you paid foreign taxes on, you can take the foreign tax credit for the tax paid on those amounts. So you can't double dip, both exclude the income and take the foreign tax credit, but you can take the foreign tax credit for amounts that were not excluded. Foreign retirement income. Foreign retirement income is generally taxed like any other retirement income. So if it comes from a taxable account, you are going to pay tax on it. This can be potentially affected by tax treaties in certain cases, but the general rule is you treat it like any other retirement income. Now we're going to switch from talking about foreign income to foreign assets. The IRS is very concerned about U.S. citizens and residents evading income tax through foreign accounts. So they want to know whether or not you have foreign accounts and where they are and what's going on with those. So if you have any of those foreign accounts, you're going to have to acknowledge that in any or all three of these different places: on Part 3 of Schedule B, on Form 8938, or on something called an F-bar. For Schedule B, you must answer yes and provide the required information on Part 3 of Schedule B if you are required to file Schedule B. So remember, the general requirement is if you've got greater than $1,500 of interest or dividends, you have to file Schedule B. There were also other times you have to file Schedule B even if you don't have more than $1,500, but that's the general rule. So if you're required to file Schedule B for any reason, and then you either had a foreign account or received a distribution from or were a grantor of or a transferor to a foreign trust, then you're going to have to say yes to the boxes in Part 3 of Schedule B. So let's look at that to see what we're talking about. This is Schedule B. You'll remember the top part, we report interest. Part 2, we report dividends. And then Part 3 down here is what we're talking about now. Now, you have to complete Part 3 anytime you're completing Schedule B. But if you don't have any foreign accounts, then you can just check no. But if you do have those foreign accounts, then you have to look at this and check yes if it applies. So first, at any time during 2025, did you have a financial interest in or signature authority over a financial account located in a foreign country? And then you have to say yes. Then it says, if yes, are you required to file the FinCEN Form 114, which is the F-bar? We'll be going over those filing requirements here shortly. So if you are required to file an F-bar, then again, you have to check yes here. Then it says, if you are required to file the F-bar, lists the names of the foreign countries where those financial accounts are located. So you have to list those right here on Schedule B. Then the next question is, during 2025, did you receive a distribution from, or were you the grantor of, or transferor to a foreign trust? You have to click the box yes here. And also it tells you you may have to file a Form 3520, which we will be talking about shortly as well. The next form you may be responsible for filing is the Form 8938 Statement of Specified Foreign Financial Assets. So for this form, you are going to report and file this form if the total value of your foreign bank and financial accounts and other foreign financial assets reaches a certain threshold amount. So if you are at or over that threshold, you have to file this Form 8938. If you're under the threshold, you do not. That threshold is going to depend on whether or not you are living in the United States and your filing status. So if you are living in the United States and you are any filing status other than married filing jointly, then if the total value of all of your financial accounts is greater than or equal to $50,000 at the end of the year, or $75,000 at any time during the year, even for one day, then you have to file this Form 8938. If you are living in the United States and you are married filing jointly, then those thresholds double. So it's greater than or equal to $100,000 at the end of the year, or $150,000 at any time during the year. If you are living outside of the United States, the thresholds are higher. I think they figure if you're living outside the United States, you're more likely to have these foreign accounts. So they give you a higher threshold. So for anything other than married filing jointly, if the total value of all your accounts equals or exceeds $200,000 at the end of the year, or $300,000 at any time during the year, then you need to file this Form 8938. If you are married filing jointly, then again, those amounts double. So it's greater than or equal to $400,000 at the end of the year, or $600,000 at any time during the year. So that is the Form 8938. Next is the F-bar. You will need to file this even if you filed a Form 8938. So the 8938 is an IRS form. The F-bar is not an IRS form. It's a form from FinCEN, the Financial Crimes Enforcement Network. It is also known as Form 114. You will want to know that for the exam. So it is FinCEN Form 114, commonly known as the F-bar. A U.S. person, including a citizen, resident, corporation, partnership, LLC, trust, estate, must file an F-bar if they have a financial interest in, or signature or other authority over, at least one financial account located outside the United States, if the aggregate value of those foreign financial accounts exceeded $10,000 at any time during the calendar year reported. Again, even if for only one day. The F-bar is due on April 15th of the following year, but remember, it is not a tax form. It is not an IRS form. You can get an automatic extension to file to October 15th. You don't even need to file a form in order to get that extension. And you must file it electronically through FinCEN's system. So you can go to their website and see how you file this form. There is a $16,536 penalty for failure to file this form. You'll want to know that number for the exam. It does change each year. If that failure to file was willful, so in other words, you're trying to avoid filing this return because you don't want the government to know about your accounts, then the fine is the greater of $165,353, or 50% of the account balance at the time of the violation. There was a kind of interesting Supreme Court case about this recently. It came out in 2023. It was called Bittner, Bittner versus U.S. Mr. Bittner was required to file this form, and he did not do so for 5 years. It was not willful. The IRS agreed that it was not willful. And at the time, this penalty was $10,000. It's $16,536 now, but at that time it was $10,000. So he realized he didn't file it. So he said, okay, I didn't file it for 5 years. It's $10,000 per year, and he paid a penalty of $50,000. But the IRS came back and said, oh, no, Mr. Bittner. It's not $10,000 per year. It's $10,000 per account. And he had, I don't remember, but I think he had dozens of accounts. So they said $10,000 per account for 5 years, and they assessed penalties of more than $2 million. So he took this to court. There had been a similar case with a different taxpayer in a different circuit court. So in the United States, you've got various circuit courts, and they're all kind of independent of each other. So one of these circuit courts had agreed with the taxpayer, had said, okay, you're right, it's only $10,000 per year. But the circuit that Mr. Bittner was in did not agree with that other circuit. And they said, no, we agree with the IRS. It's $10,000 per account. You owe over $2 million in penalties. So the United States Supreme Court agreed to hear this case in order to resolve this difference between the circuit courts and how they had ruled. And ultimately, what the Supreme Court ruled was they ruled in favor of the taxpayer, and they said it is only $10,000 per year, not $10,000 per account. So that obviously did save him millions of dollars. Of course, he had to spend a lot in legal fees and court costs, and I'm sure there was a lot of stress, but he saved himself a couple $1,000,000, and he saved some future taxpayers a lot of money and hassle as well. Next is Form 3520 for foreign trusts and gifts. So we know the IRS is always worried about any type of foreign accounts. They are particularly worried about foreign trusts because foreign trusts can often be set up to try to evade U.S. taxes. So they want to know about any foreign trusts. So any U.S. persons must file a Form 3520 when contributing property to or entering into certain transactions with a foreign trust. You just need to know about this for the exam. If you want the particulars, you can look at the instructions to that Form 3520. And then another form that you'll want to know about is the Form 5471. So U.S. officers, directors, and or shareholders of certain foreign corporations have to file a Form 5471 in order to report their ownership. And again, you can see the form instructions for details. Moving on to our next specialized topic, and that is rental real estate. Rental real estate is kind of a funny one because technically it's supposed to be part of part 2 of the exam, and we are going to cover it in much more detail in part 2 than we do here. But I've gotten reports from students saying they are actually getting a question or two about rental real estate in part 1 of the exam. So I want to give you enough information to answer the types of questions you might see in part 1. And if you want the full discussion of rental real estate, then you will want to follow on to part 2 of this course. If you have rental real estate, then you are going to report that on Schedule E of the Form 1040. If you own a part interest in a rental property, then you report only your share of income and expenses. So let's say you and your sister own a rental property together, 50-50. Then you would report half of the income, half the expenses on your Schedule E, and she would report half on her Schedule E. Rental activities are, by default, considered passive, so the passive loss rules apply. Remember, passive losses can only be used to offset passive income. So rental real estate is considered a passive activity. There is an exception for someone called a bona fide real estate professional that we will talk about in part 2. But basically, that's somebody whose profession is real estate. They would not be considered passive. But for everybody else, it is a passive activity. And then if you have real estate and you provide substantial services, such as regular cleaning, changing of linens, or housekeeping, then that is a business reported on Schedule C. It is not a rental property. So for example, if you have a place that you are renting out through Airbnb or a similar type of service, that is a business, not a rental activity. So let's look at this Schedule E. This is the first page of the Schedule E, which is where you report your rental income. So at the top, you're going to put the address of each property and the type of property. If you rent it some and you use it personally some, then you're going to put the number of days that you rented it and the number of days that you used it personally. Then you're going to get down here where you're going to actually list the income and expenses for each property. So you've got A, B, and C, which corresponds to A, B, and C up here where you have listed the addresses. So you're going to put your income, your rents received, and then all of the various expenses that you may have. And that's going to come down to your net income. So remember, for the exam, it is Schedule E that you report your income and expenses from your rental property. As we said, rental real estate is considered a passive activity, and you can only deduct passive losses against passive income. You cannot, in general, deduct passive losses from your salary and your investment income, etc. However, there is this exception that they may ask about on the exam. So it is the $25,000 passive activity loss exception for rental real estate. This applies if you have rental real estate and you actively participate in the activity. Active participation means you own at least 10% of that property and you make management decisions in a significant and bona fide sense, such as approving tenants, rental terms, and expenditures. So this exception is meant for your average middle class person who has a rental house, they rent it out on the side, they are making the decisions about who they rent to and et cetera and so forth. That's what this is designed for. If you actively participate in that activity, then you can use up to $25,000 of losses from that rental property to offset your non-passive income. So if you got your regular salary, your regular job, and you have a loss on that rental property, you can go ahead and deduct up to $25,000 of that loss on your tax return, even though it is a passive activity. However, this is phased out for taxpayers with higher income. So that allowance is reduced by 50% of the amount that your modified adjusted gross income exceeds $100,000 or $50,000 married filing separately. If you have more passive loss than you can take for the year, the excess will carry over to the following year. Next, we'll talk about renting part of a property. If you rent out part of a property, such as a duplex or a basement apartment in your home, then you're going to divide the expenses that affect the whole house between personal and rental. So things like mortgage interest that you paid, utilities that were paid for the entire house, real estate taxes that were paid, maintenance that's done on the entire house, such as painting the whole house or putting a roof on the whole house. You need to divide these expenses between how much is personal and how much is rental. You can divide it based on the total square footage or the number of rooms, whatever makes the most sense in your case. So let's look at an example. George and Louise own a duplex. Both units are the same size, and they live in one of the units and rent out the other one. The units have separate electric, gas, and water meters. During the year, they pay mortgage interest of $7,000, real estate taxes of $4,000, HOA fees of $300, and have the outside of the home painted for $3,000. In addition, the utilities for the unit they live in are $2,400, and they have their kitchen floor retiled for $2,000. They also pay to have the inside of the rented unit painted for $2,000 and pay for various repairs in that rented unit for $1,200. How much of the listed expenses can they deduct as rental expenses on Schedule E? So here we've got a question. We've got to go through each expense and decide, is it personal or is it rental? So let's look at the answer. So here's what is deductible. For the mortgage interest of $7,000, they can deduct half, $3,500. Remember, they live in one half, they rent out the other half. So it is exactly 50-50. So they can deduct 50% of all of the common costs that affect both units. That includes the mortgage interest. It also includes the real estate taxes. They can deduct half of those. Also the HOA fees, half of those. When we get to the utilities, because they are on separate meters, they cannot deduct the utilities for their own unit. That's their own personal expense. They cannot deduct any of that. They also retiled their own kitchen, not the part that they are renting, but their own. They cannot deduct any of that. That is a personal expense. But for the expenses that related just to the rental unit, so the painting and the repairs, they can deduct 100% of those because they were all for the rented unit. So their total rental expenses end up being $8,850. Now, in this case, it was 50-50 since it was a duplex. Let's say instead they were renting out a basement apartment that they had. Well, in that case, they'd probably do something like square footage. So let's say the basement apartment is 1,000 square feet and the total living space in the home is 3,000 square feet. So you take 1,000 divided by 3,000 and you say, okay, 1/3 of all the common expenses could be deducted. And in that case, let's say that basement apartment does not have separate meters for the utilities. It's just all on one. In that case, you could actually deduct 1/3 even of the utilities. So if you have any question on the exam, just remember that anything that's personal, so if it just seems like that's a personal expense, then that is not going to be deductible. But if it is a rental expense, clearly a rental expense, then that is going to be deductible. And if it's an expense that affects the entire property, then you're going to take that relevant percentage related to the rental unit and you can deduct that much of those expenses. That should be enough to get you through part one of the exam. Again, part two, we'll talk about it in more detail. Our next specialized return is for household employees. If you have a household employee, you may need to withhold and pay Social Security and Medicare taxes, or pay FUTA, which is federal unemployment tax, or both. You do not need to withhold federal income tax from your household employee's wages, but if they ask you to, you can if you want to. So it's up to you whether or not you withhold any income tax from a household employee's wages. There is a publication 926, that goes into more detail about all the things we're going to be talking about here for household employees. So there are various types of household employees that you could have. All of those things listed on the slide here: babysitters, butlers, caretakers, cooks, etc. Any of these could potentially be household employees. So how do you know whether or not someone is considered a household employee? Well, you have a household employee if you hired someone to do household work and that worker is your employee. The worker is considered your employee if you can control not only what work is done, but how it is done. If the worker is your employee, it doesn't matter whether they're full-time or part-time, whether you hired them through an agency or from a list provided by an agency. It also doesn't matter whether you pay them hourly, daily, or weekly, or by the job. If they are an employee, they are an employee, and these rules apply. Sometimes it helps to understand what is an employee by looking at examples of what is not an employee. So if only the worker can control how the work is done, then that worker is not your employee, but they are self-employed. A self-employed worker usually provides their own tools and offers their services to the general public as an independent business. If an agency provides the worker and controls what work is done and how it is done, then that worker is not your employee. It's the agency's employee. So let's think of a couple of examples. Let's say you hire someone to come over and cut your grass and do yard work. They come over, they use their own lawnmowers, their own tools, and then they move on and they go to work on someone else's house. Clearly, that person is not your employee. You do not have to worry about them. They are someone in the business of cutting grass and doing lawn work, not your employee. However, let's say you have a caretaker for an elderly person. You've got an elderly person, they're no longer able to take care of their property. Maybe they've got a large property, several buildings, and they hire this person to come on and to take care of the grounds. That person may even live there on the premises. they're going to use the homeowner's tools and lawnmowers, etc., in order to do the work. It is essentially their full-time job. They may occasionally do work for other neighbors or for other people, but their main job is being the caretaker of that elderly person's property. Well, that sounds an awful lot like an employee. Or let's take childcare. Let's say you have a nanny. They come to your house from 7 in the morning until 5 in the afternoon, Monday through Friday. It is essentially their full-time job. Yes, they may babysit occasionally for other people on nights and weekends, but their job is working at your house as a nanny. Again, they are going to be an employee. Now, it would be different if they worked for an agency. So there are these agencies that provide, for instance, nannies. So the agency controls where they work and when they work. And if that person can't show up one day, they'll send somebody in their place in order to make sure that you're covered. Well, in that case, that person is going to be an employee of the agency, not your household employee. So hopefully that gives you an idea of who might be considered an employee and who is not. If you do have a household employee, then you have to file a W-2 for each household employee if you paid them $2,800 or more during the year, or if you withheld federal income tax. So remember, you don't have to withhold federal income tax, but if you do, even if you paid them less than $2,800, you still have to file a W-2. You file the W-2 just like any other employer by January 31st of the following year. The employee gets copies B, C, and 2. The government gets copy A along with a transmittal form called a Form W-3. You may also have to report to a state taxing authority. Of course, that won't be tested on the exam. And the W-2 is an information-only return. So when you send the government their copy, you just send them the form. You don't send any money with it. If you do file one or more W-2s, then you will need an EIN, an employer identification number. These are easy to get. You can get it on the IRS's website in just a few minutes. And there's a few reasons that you want to get this EIN. First of all, because they tell you to. Secondly, because if you don't use an EIN on the W-2, your only other option is going to be to use your Social Security number. With all the identity theft out there, you do not want to be giving your Social Security number out to your employees. And then the third reason is because your employees don't want you to put your Social Security number on there either. Because if they go to their tax preparer or they try to file their own taxes with a W-2 that has a Social Security number on it instead of an employer identification number, they will not be able to electronically file that return. The IRS will reject that return for not having an EIN. So if you have clients that have household employees, help them to get an EIN. Next is Schedule H. If you have to pay any type of household employment taxes, then you will fill out Schedule H and attach it to your 1040. And then these taxes get paid as an additional tax, as we talked about in a previous video. Schedule H is used to compute and pay employment taxes, which includes Social Security, Medicare, and the federal unemployment tax. It's also used to compute and pay any income tax that was withheld for those household employees. You must file a Schedule H if you paid $2,800 or more to a single employee, or you withheld federal income tax from an employee, or you paid any wages subject to federal unemployment tax, which means greater than or equal to $1,000 in any quarter to any one employee. So if you had any of these things, then you are going to have to pay household employment taxes and file the Schedule H. Again, it is an other tax on the 1040. If the taxpayer is not required to file a 1040, they can actually file Schedule H by itself. And then also you want to remember that you may also have state unemployment tax and income tax withholding as well. So here is a chart from that publication 926 that we talked about earlier. So, do you need to pay employment taxes? So, again, it's going to say what we just talked about with a little bit more detail. So, first of all, if you pay cash wages of $2,800 or more to any one household employee, then you are going to have to pay employment taxes. However, it does say you do not count these wages. Any wages paid to your spouse, paid to your child under age 21, paid to your parent, or paid to any employee under the age of 18 at any time in 2025. Now, it doesn't mean you don't have to issue them a W-2. This chart is not talking about the W-2. It's talking about whether or not you have to pay employment taxes. So in any case, if you do pay these cash wages of $2,800 or more, then you need to pay over Social Security and Medicare taxes. So those taxes are 15.3% of the wages, 7.65% is the employee share, 7.65% is the employer's share. As the household employer, you can choose whether or not to withhold from the employee's paycheck their 7.65%. Your other option is just to pay it all yourself. So what a lot of household employers will do is they will just go ahead and pay the entire 15.3% on their Schedule H. But you don't have to. You can withhold the 7.65% from your employees. Then the other time, as we already discussed, that you may need to pay taxes is federal unemployment tax. So here it says, if you pay total cash wages of $1,000 or more in any calendar quarter in 2024 or 2025 to household employees, then you need to pay the unemployment tax. For this purposes, you do not have to count any wages that you pay to your spouse, your child under age 21, or your parent, but you do still have to count any other employees under the age of 18. And so for this tax, it is 6% of cash wages up to a maximum of $7,000. So it's 6% times $7,000 maximum would be a maximum of $420 of federal unemployment tax. And then a reminder that you may also owe state unemployment tax. Our next topic is marriage and divorce. So the first thing we're going to talk about is a couple of special circumstances. One is called injured spouse. The other is called innocent spouse. These are two separate things. So we want to make sure that you understand each of them. So let's start with injured spouse. Generally, the IRS will offset any current refund to pay past due tax debts. So if you have a tax debt from a prior year that you have not paid, then you file this year's tax return and you're supposed to get a refund. Well, you're not going to get that refund. The IRS is going to keep that money in order to pay that past due tax debt. Well, that can offer a challenge when you have a married couple and only one of the spouses actually owes a past debt. So if you have a couple that is filing jointly and only one spouse owes the IRS, that other spouse can then file as an injured spouse. So this happens a lot, for example, when couples first get married. One of the spouses may have a tax debt, and they may not realize that when they file their return, any refund is going to go to pay that past tax debt. So, of course, this doesn't seem fair to the spouse who did not have the tax debt. So let's say the husband has a past tax debt, the wife does not. They filed a joint return, supposed to get a refund, but the IRS is going to keep that refund to offset the tax. So what the injured spouse can do is they can file this Form 8379. This allows them to get their portion of the refund, so it will not be used to offset their spouse's tax debt. So it can either be filed with the joint return. So if you know in advance, okay, we're going to have this problem, then you can go ahead and file the 8379 with the return. Or it can be filed after the return. So maybe you didn't realize your spouse had this debt, or you didn't realize they were going to take the whole refund to pay that debt. Then you can file the 8379 after the fact in order to get your money back. So that is an injured spouse. Again, it is different from an innocent spouse. So what is an innocent spouse? Well, normally, of course, if you are married filing jointly, you are jointly and severally liable for the tax on the return. Both parties are responsible for the tax on that return. The IRS can go after either or both of them to get that money. But when one spouse is doing something wrong or illegal, and the other spouse is not aware of it and is not involved in it, that spouse can file as an innocent spouse. They can say, hey, IRS, this has nothing to do with me. I knew nothing about this. Don't come after me for these amounts. Go after my spouse. I am an innocent spouse. In order to file for this, they file this Form 8857, but it is not automatic. The IRS is going to look at the facts and circumstances and determine whether or not that spouse truly is innocent. There are some interesting court cases about this, and they usually deal with rich people who live very fancy lifestyles. So they're kind of interesting reading if you're a tax nerd like me and you like to read tax cases. But you'll have these cases where the spouse, usually the wife, because these are older cases, but it doesn't have to be, of course. But the wife will be saying, hey, look, I knew nothing about this. And then the IRS is arguing, oh, yes, you did. And then they go to court to argue about it. And you can see all of this play out in these court cases. So to be an innocent spouse, you're going to have to actually be innocent, meaning not only were you not involved and not aware of what was going on, but you also were not just sticking your head in the sand. So you might have a wife, for example, in one of these cases, who's living a very extravagant lifestyle, and their husband is providing all kinds of gifts for them. They're going on all kinds of vacations. They live in a big house. They're driving fancy cars. But then their husband does a tax return, has his own business, and he reports some really low amount of income. He says, oh, we've got $40,000 of income. And the spouse just signs the tax return and sends it in. Then later she tries to say, well, I didn't know. He said it was $40,000. I have nothing to do with his business. And the IRS says, no, no, no. You were living the life. You knew that $40,000 a year was not going to fund the lifestyle that you were living. You are not an innocent spouse. So then you have these cases that go to court. But if you have a spouse who really doesn't know, had nothing to do with them, had no reason to know about this activity, then they can file this Form 8857 and possibly get this innocent spouse relief. And then the IRS will just go after the other spouse. Community property states. In community property states, earned income is generally considered to be owned 50-50 by the spouses. So if you file married filings separately and you live in a community property state, each spouse is going to claim 1/2 of all the earned income and any withholding. Even if only one spouse works, both spouses will claim half of the earned income. Or if both spouses work, you're going to add up the total of the earned income, divide by 2. Each spouse reports 50-50. That is only for earned income. IRA distributions are taxable to the spouse named on the account. And for more information, you can get this publication 555. But here is a list of the community property states. You do not have to memorize this list. If you get a question on the exam, they will tell you that it was a community property state. Some of the prominent ones, like California, you'll sometimes hear about these cases involving celebrities, and the fact that it is a community property state will come up. And then you can see some of the other ones on the list as well. Alaska, Tennessee, and South Dakota are kind of hybrid type of states, so they are special cases. But again, for the exam, just know what we said on the previous screen about the earned income being treated 50-50. So now let's talk about divorce. We've actually talked about these things as we've gone through the course, but this is just going to be a reminder here all in one place. We'll talk about alimony, child support, and property transfers. So as we have said a couple of times, if you have a divorce agreement prior to 2019, then any alimony that is paid is deductible by the one paying it and is included in the income of the one receiving it. If it is a divorce in 2019 or later, then the alimony is not deductible by the one paying it. The alimony is not included in the income of the one receiving it. For child support is never deductible by the payer, and it is not included in the income of the recipient. I think we have covered that enough times that you get the point. And then for property transfers, remember, as we said, property transfers incident to divorce do not result in any gain or loss. But what does incident to divorce mean? Well, a transfer will be considered incident to divorce if it is made within 1 year of the date of the divorce or made under an original or modified divorce agreement within 6 years after the divorce. So even if there is nothing in the divorce agreement, if the transfer happens within 1 year of the divorce, it will automatically be considered incident to divorce, no tax. If it is part of the agreement, then as long as the transfer occurs within 6 years after the divorce, it will be considered incident to divorce. Retirement plans through an employer can get special treatment during a divorce. So there could be times where the non-employee or the non-participant is awarded a retirement plan in a divorce. So for example, you could have the wife is working, she's participating in her 401k plan at work, and as part of the divorce agreement, her husband is getting all or a part of that 401k plan. When that happens, the judge will issue something called a Qualified Domestic Relations Order, or QDRO. That orders the plan administrator to award part or all of that plan to the non-participant spouse. The distribution to that non-participant spouse will be taxable if it was a taxable account, but they don't have to worry about the 10% penalty for early withdrawal, and they can make it non-taxable if they just roll it into an IRA or into another qualified retirement plan. So if they just take the money, they're going to have to pay tax on that money if it's a traditional account. But if they roll it over into another retirement account, then they do not have to pay any tax or penalty on that. For an IRA, as opposed to an employer plan, no QDRO is required. And remember, all transfers of IRAs incident to divorce are not taxable events. Our next topic is estate and gift tax. So both estate and gift tax deal with the tax effects of giving away or transferring assets. So a gift is given before the giver dies, and an estate is after the giver dies. In either case, strictly speaking, the recipient does not pay income tax on the transfer itself. So if you get $100,000 from a bank account from your parent who died, there is no tax on that. But there could be income tax consequences of owning or selling the asset. Gifts and transfers on death above certain thresholds may be subject to gift or estate taxes, but they're not subject to income taxes. So again, the person receiving it is not going to have any income tax, but the person making the gift or the estate may have to pay a gift tax or an estate tax. But it is not the person receiving it that pays the gift or estate tax. It is the giver or the estate that pays that tax. Not all gifts or estates are going to be subject to any kind of tax. Everyone gets a lifetime combined gift and estate exemption that is not subject to any tax. For 2025, that exemption is $13,990,000. So that means the vast majority of Americans will never have to worry about a gift or estate tax. It is only going to apply to wealthy people. And if the decedent is married, their spouse can actually get a double exemption. So you can have it set up so that when you die, your assets all transfer to your spouse. Then they will not become subject to estate tax until the spouse dies. But now the spouse gets a double exemption to $27,980,000. So whatever your exemption is, the way this works is during your lifetime, if you give gifts above certain thresholds that we'll talk about next, But if you give gifts during your lifetime, that will reduce this $13,990,000. So if you give $300,000, now your exemption is $13,690,000. And so throughout your life, you keep reducing your exemption. And then once you die, you can use your remaining exemption for the estate tax. So let's look first at the gift tax. In addition to that lifetime exemption, there is an annual exclusion amount for gifts that you do not have to count. So the exclusion amount for 2025 is $19,000, and this does go up each year with inflation. But the 2025 amount, you want to know for the exam, is $19,000. You will almost certainly get a question on the exam testing that. What this means is you can give someone $19,000 without reporting it and without counting it against your lifetime exemption. So you don't have to reduce your lifetime exemption for any gift that is at or below the exclusion amount. There's also something called gift splitting. If you are married, you and your spouse can each give $19,000. So, for example, a married couple could give their child $38,000 without affecting the lifetime exemption. If the child is also married, each parent could give the child and their spouse $19,000 each, meaning they could transfer $76,000 without any gift tax and without affecting the lifetime exemption. So it doesn't matter whose account it comes from. If you are married, let's say you give $38,000 to your child, it all comes from the wife's separate bank account. Doesn't matter, you are married, so that $38,000 exemption will be split between the spouses. They don't have to pay any gift tax. They do not have to reduce their exemption. Now, they will have to report it. We'll talk about that here shortly, but it doesn't have any tax effect. There are also exceptions to the $19,000 limit. So even if you give more than $19,000 to someone, it is not reportable and does not count against your lifetime exemption if the gift was for educational expenses for tuition paid directly to the school. So it is only for tuition, and it does have to be paid directly to the school, but you do not have to report that gift. And that is for any level. It could be grade school, high school, college, doesn't matter. As long as it meets the criteria, then it does not have to be reported. Similarly, if you pay medical expenses for another person, as long as those payments are directly to the care provider, so the doctor, the hospital, etc. Also, any amount that is gifted to your spouse who is a U.S. citizen. So as long as your spouse is a U.S. citizen, you can give them any amount, does not count as a gift. We'll talk about what happens if the spouse is not a U.S. citizen in a little bit. Also, any political donation is not considered a gift. You don't have to worry about this. And a qualified charitable donation is not a gift, so you do not have to worry about gift tax. If you do give more than $19,000 to any one person in 2025, and you don't meet one of those exceptions we just talked about, then you do have to file a gift tax return. That is Form 709. It is due by April 15th, but it is separate from the 1040. You don't file it with the 1040. And spouses may not file a joint gift tax return. So even if they file a joint income tax return, they have to file separate gift tax returns, and they may still have to file a gift tax return to show those split gifts. So remember, we said you can give $38,000, there's no tax effect, but you might have to report it. So because you are still giving more than $19,000 to any one person, you do have to still fill out the Form 709. So each spouse would fill out a 709 showing that they gave $19,000 to that person. Still don't pay gift tax, still does not reduce your lifetime exemption. You're just letting the IRS know, hey, we did give more than $19,000 to this person. However, it was split between us. If you do have a gift in excess of $19,000, then you've got a choice. You can either apply the excess toward your lifetime exemption, like we talked about before, or you can pay a gift tax. So if you don't want to reduce that exemption by the amount of your gift, you don't have to. But if you choose not to, then you're going to have to pay the gift tax, which ranges from 18 to 40%. Now, again, most people are never going to have to worry about this $13,990,000. So if they give more than $19,000, they'll just go ahead and reduce that exemption. Don't pay any tax. Don't have to worry about it. But you could have very wealthy people who want to save that exemption for when they die. So they would rather just go ahead and pay the gift tax now while they're alive and they give the gift. So they have the option to do that. And remember, it is always the gift giver who is responsible for paying the gift tax, not the one who receives the gift. And you also want to know when you are giving a gift. And what I mean by that is a gift can be in cash, can be in property, can be in debt forgiveness, can be in a below market sale of a property. So if you forgive someone a debt, let's say they owe you $40,000, you forgive that debt, that is generally going to be a gift, has to be reported. Or let's say you have a house that's worth $300,000 and you sell it to your adult child for $100,000. You have just given them a $200,000 gift, has to be reported on the 709. And remember, those gift tax rates are from 18 to 40%. Don't have to worry about exactly where the breakdowns are, just know those percentages. Now let's talk about that gift to a non-citizen spouse. Of course, as we already said, gifts to a spouse who is a U.S. citizen are fully excluded and do not have to be reported. If the spouse is a non-citizen, then only the first $190,000 is excluded. So it's 10 times the normal annual gift exclusion amount. Any amounts in excess of $190,000 would be reported on the Form 709, and then you either pay the gift tax or you reduce the lifetime exemption. So this is for any non-citizen spouse, even if they are a resident alien. Doesn't matter. If they're a resident alien, a non-resident alien, or a dual status alien, it is a $190,000 exclusion. Now let's talk about the estate tax. At death, the decedent's gross estate consists of virtually all of their assets. From that gross estate, you will deduct certain things. You can deduct funeral expenses, administrative expenses, attorney fees, along with some allowed adjustments. Once you subtract those things, that results in the taxable estate. Then you're going to compare that taxable estate to the remaining lifetime exemption. So everybody has that $13,990,000. You subtract any gifts that were used to offset that. You compare the estate to that remaining lifetime exemption. If there is any excess, then that amount is subject to estate tax. In part 2, we will actually look at how the estate files their tax return. For now, just know that they could be subject to this estate tax if the estate is larger than that exemption amount. In order to file a return for an estate, you are going to use this Form 706. That is for any taxable estate in excess of the lifetime exemption. So again, most people are not going to have an estate that is larger than that lifetime exemption, so most people will never have to file an estate tax return. But for those people that do, you use this Form 706. Now you'll remember that the gift tax return is the 709. The estate tax return is the 706. This can get confusing because a 6 is just like an upside down 9. So I'm going to give you an easy way to remember which form you use, because on the exam, they might test this, whether it is a 706 or 709. So I apologize in advance if this is crass or insensitive, but I'm trying to give you an easy way to remember this. You give a gift while you are alive. So if you think about that 9, the loop on the 9 is up. It's above the ground for a gift. A 706 is for an estate tax. That is after you die. So the loop on the 6 is down below. It is below the ground. So 706 is when you are dead, below the ground. 709 is for when you are alive, above the ground. And then the other way to think about it is a 706 is for when you are 6 feet under. So when you are dead. So that's how you can remember those. You also file the Form 706 in order to elect that portability for the surviving spouse. Remember when we said you could double the amount of your exemption when one spouse dies and leaves all their assets to the other spouse? Well, you have to elect that. And the way you elect that is when the spouse dies, you file this Form 706 to show that the surviving spouse is going to get the double lifetime exemption. If you file a Form 706, it is due 9 months after the date of death. You will want to remember that. That can be extended 6 extra months by filing Form 4768. And again, the estate tax rates range from 18 to 40% because it is all one combined tax. It is a gift and estate tax, so it is the same tax rates. Generation skipping transfer tax, or GST. So estate and gift taxes are meant to tax transfers of assets as they pass from one generation to the next. So for example, an asset owned by a grandparent would be taxed when it passed from them to their child, and then again when it passed from their child to their grandchild. So some wealthy people used to skip the first of those transfer taxes by just gifting or bequeathing the assets directly to the grandchild. So the GST closes that loophole by imposing a 40% tax on such transfers. So if grandma or grandpa is going to give or bequeath something to their grandchild, they're going to have this generation skipping tax to pay. Now, this only applies to people with assets in excess of the lifetime exemption. So most of us don't have to worry about it. And it also disregards any spousal portability. So where you get to double that exemption, that does not apply for the GST. You only get to count your lifetime exemption, not the doubled lifetime exemption. Next, let's talk a little bit about estate planning. You do not need to be anything close to an estate planning expert to pass the EA exam. You just want to be generally familiar with these things. Trusts. A trust is an entity formed under state law to hold assets for the benefit of a beneficiary. They are often used for estate, family, and business succession planning. There are 3 parties to a trust. There is the grantor, that's the one who contributes property to the trust. There is the trustee, also called the fiduciary. That is the person or entity responsible for carrying out the terms of the trust. And then there is the beneficiary. So that is the person who receives the income and or the assets of the trust. That can be the same person as the grantor in some cases. So you can put assets into a trust for your own benefit. That is possible to do that. A trust is a separate legal entity and therefore may be required to file a tax return. A trust that does file a tax return is also a pass-through entity, and so they will issue Schedule K-1s to the beneficiaries. So we've talked about that earlier in this course, where you could have income from a trust. Remember, you report that on Schedule E, just like you report income from an S Corp or a partnership. So trusts can be used to avoid probate and sometimes to lower estate taxes. Why is avoiding probate a big deal? If your assets go to probate, it becomes a public record. So it goes to court, everybody's going to know your business, exactly what you own, what you owe, etc. If instead your assets go into a trust, that does not go into probate, so it is kept private. So that's one of the big benefits. Then it also can just make things easier to pass on to your heirs. You can make your intentions known. It makes it a smoother process and sometimes can help to lower estate taxes. There's lots of different kinds of trusts. We will talk more about it in part 2. For now, we're going to talk about a couple of different kinds. Revocable and irrevocable can also be pronounced revocable and irrevocable, so whatever you like. But a revocable or living trust is used to avoid probate and leave specific assets to specific beneficiaries. So these are very common. We usually just call them a living trust. So you go to a lawyer, you set up one of these trusts, and then you put your significant assets into the name of the trust. So you put your house in the name of your living trust. You put your bank accounts in the name of your living trust. You might put your car in the name of your living trust. Or you can have the living trust be your beneficiary. So you can have a beneficiary on your retirement account at work. That beneficiary can be your living trust. So then when you die, all of those assets now belong in that living trust. And then that living trust will spell out what happens to those assets after your death. It is a revocable trust because you can put things into the trust and take things out of the trust at will. As long as you are alive, you can put things in, take things out as much and as often as you want to. An irrevocable trust is one that can be used to move assets out of your estate and to protect them from creditors and transfer them to specific beneficiaries. So with an irrevocable trust, it cannot be revoked. So once you put an asset into that trust, you cannot take it back out again. One of the big benefits of that is it is no longer considered part of your estate. Because the trust is a separate legal entity, you don't own it anymore. The trust does. So when you die, it is generally not going to be considered part of your estate when you're looking at that $13,990,000 exemption amount. And then, as we said, there are many other types of trusts that can be used for specific needs. Next, let's talk about family partnerships, specifically family limited partnerships. These can be set up to own a business with family members and trusts as partners. Now, these are a bit controversial. You have to be very careful with them because the IRS is a bit leery of these, so you are likely to get scrutiny and audits from the IRS. That said, they can absolutely be legal and legitimate. They're just very complicated. So what's someone who owns a business? Let's say you've got the patriarch of the family. They've got this business that they own. They want to pass it on to their heirs. And they want to do that with the lowest amount of gift and estate tax that they can. What they will do is transfer that business into a family limited partnership. They may transfer it first into a trust and have the trust be the partner in the partnership, or individuals can be partners in the partnership, or a combination of trusts and individuals can be partners in the partnership. Once they transfer that business into the partnership, the value of that business is reduced. There are experts who do business valuations. They will determine how much is a business worth. When they are determining that, they will discount or lower the value based on certain factors. One of those is lack of control. Another is lack of marketability. In other words, of the ability to sell the business. Well, once you transfer the business into this partnership, that patriarch of the family no longer has complete control over the business, and it's much harder to sell that business once it's in this partnership. Those two things reduce the value of the business. So that automatically reduces the value of your estate. Then once you've done that, partnership interests can be gifted over time, allowing the business to be passed from generation to generation. Remember, you can give up to $19,000 each year to any individual. So this patriarch of the family could give $19,000 to each of their children, maybe to their grandchildren, etc., each and every year. And that $19,000 goes up every year. It's going to be a little bit more. Then remember, you've got gift splitting. So if the patriarch is married, they can give $38,000 to any one person. And if the person they're giving it to is married, they can give each of them. So they can give $76,000, as we talked about before. So by giving partnership interests every year over time, you can slowly transfer that business to the next generation, maybe the generation after that, by making these non-taxable gifts. So you can see that you can save a lot of estate tax if you've got a very large and valuable business. But there are downsides. First one we already mentioned, that is that the IRS is probably going to look at this. So you are going to likely get audited and you're going to have to make sure it's all set up right. And that means it's going to be very expensive. It's expensive to set it up and it's expensive to maintain it. You're going to have attorneys. You're going to have accountants. You're going to have all these tax returns. You start putting assets into trusts. Now every trust has got a tax return. You've got this partnership. The partnership has a tax return. And you've got multiple people. So you're going to have multiple individuals. Their individual tax returns are now much more complicated because of all this. You've got a lot of administrative costs and hassles that are involved with this. Plus, there does have to be at least one general partner. As we'll talk about in part 2, a general partner is exposed to liability from the business. So that is another downside. And then one thing you want to know is that there does have to be a valid business purpose for doing this, not primarily to save taxes. So if the IRS looks at it and says, well, the only reason you set this up was to save taxes, there was no actual valid business purpose, then this will not be allowed and it will all have been for naught. So again, this can be completely legal and legitimate. Of course, this is not something that you would ever do on your own. This is not something I would ever do on my own. You refer this out to an attorney who specializes in this. And then maybe you could be involved in doing some tax returns on an ongoing basis, but you're going to let the attorneys who know how to do this actually figure it out and set it all up. Our next estate planning move would be charitable giving. So charitable giving during your lifetime moves assets out of your estate, may result in a tax deduction, and as we said before, can avoid capital gains tax on appreciated assets. You can also set up something called a donor advised fund. That is a charitable fund that is maintained by a public charity. So a public charity will help you set this up because they hope to get some contributions as a result of it. So you set up one of these donor advised funds, you get an immediate tax deduction for the amount that you contribute to it, and then you can make continuing deductible contributions each year, and you can advise which charities that fund should support. And then other family members can also donate, get deductions for those donations, and then you can make this a lasting lifetime legacy. This fund can continue on through the generations, helping to support various charities. Another option we've talked about before is the qualified charitable distribution, or QCD, from an IRA. You can take $108,000 per year, goes directly to the charitable organization. You don't have to pay tax on it, counts as a required minimum distribution, and helps to support that charity. There are also a couple of different charitable giving trusts that you will want to know about for the exam. The first is called a charitable remainder trust. It is an irrevocable trust, and you donate assets, and those assets are used to provide you or your beneficiaries with income during your lifetime. When you die, the remainder goes to the charity of your choosing. So, for example, let's say you own some stocks. What you can do is you can contribute those stocks to this trust. It is irrevocable. So once you contribute them to the trust, you cannot get them back out. But then what happens is, let's say those stocks produce dividends. As long as you are alive, you get the dividends from those stocks. Once you die, the stocks themselves will then be given to a charity of your choice. Of course, while you are alive and receiving those dividends, you will be paying taxes on those dividends. So the trust will do a tax return. They will issue you a K-1 with those dividend amounts, which then you will pay tax on your tax return. The other type of trust is called a charitable lead trust, and this is kind of the opposite of the charitable remainder trust. Here, you donate the assets to the trust, but instead of the income coming to you, the income goes to the charity of your choice. So you put those stocks in while you are alive, the charity gets all the dividends from those stocks. Then, when you die, the stocks are then given to the beneficiaries. Now, with a charitable lead trust, those dividends go to the charity. Of course, the charity is tax exempt, so they would not have to pay taxes on those dividends. However, the IRS is not going to let you get away with that. So what's going to happen is the trust itself is going to have to pay tax on those dividends. So the trust is going to receive the dividends because they're the ones who own the stock. Then the trust will pay income taxes on those dividends, and then what's left after paying taxes will go to the charity. So just remember, with the charitable remainder trust, the remainder goes to the charity. Income during lifetime goes to the beneficiary. The underlying assets go to the charity at death. Charitable lead trust is the opposite. The income goes to the charity during your lifetime, and the assets go to your beneficiaries at death. Life insurance. As we said before, life insurance proceeds are not subject to income tax, but they are generally part of the gross estate. So if you have a $1 million life insurance policy and you die, your beneficiary is going to get that $1 million. They don't have to pay any income tax, but that counts as $1 million in your estate. So when you're looking at, do I have $13,990,000 of estate, you have to include that $1 million in there. An irrevocable life insurance trust can be used to set aside funds to pay estate taxes. This keeps the proceeds out of the estate and saves your heirs from needing to sell assets in order to get cash to pay taxes. So you may have a person who has a lot of assets, but they are not liquid assets. When we say liquid, we mean cash or close to cash. So for example, you may have someone who owns a lot of real estate. Real estate is not very liquid because it is not easy to turn it into cash. Whereas if you had something like stocks, well, it's pretty easy to sell stocks and to get cash for them. Not so with real estate. Not so with a business. Those are not as easy to sell. And you may not want to sell them. So if you want to pass on your business to your heirs, of course, you don't want them to have to sell the business. You want to keep the business going. Or if you've got all this real estate, you may not want them to sell the real estate. You might want to keep that real estate in the family. Well, if you've got one of these large estates, but it doesn't have much in the way of liquid assets, how is the estate going to pay the estate tax? The estate can be in a position where the only way they can pay the estate tax is to sell assets, which is exactly the opposite of what the person wanted to do. So one way to fix that problem is with life insurance in an irrevocable life insurance trust. So you buy a life insurance policy. It is owned by this trust. When the person dies, the proceeds go to the trust. Since it is an irrevocable trust, those proceeds are not considered part of the estate, but they can now be used to pay for the estate tax. So you don't have to sell any of those assets in order to pay your estate tax. In addition, life insurance can be used to equalize the estate between heirs, since some assets are difficult to divide equally. So let's say you've got a house and you want to pass that house on to one of your children. Let's say you've got 5 children. Well, you could just leave it to all 5 of them, and now they own 1/5 of the house, but that might not be what you want to do. It might be a case where you want one particular child to have that house. So what you can do is you can leave that child the house, then you can have life insurance set up for each of the other 4 children to give them an amount equal to their share of the house. Same thing with a business. Maybe you've got one child who actually works in the family business, so it makes sense to leave the business to them rather than the other kids. So you can do the same thing. You can also have life insurance where the beneficiary is a charity. So in that case, the estate gets a deduction equal to the amount of the proceeds. So what happens is the proceeds from the life insurance still count as part of your gross estate because they're not in any type of irrevocable trust. But since the proceeds went to a charity, the estate gets a deduction. Remember, we said that the estate gets to deduct certain costs and adjustments. One of the things they can deduct is charitable contributions. So it goes in the gross estate, but then it comes out as a deduction. So it ends up not being included in the estate that we're going to compare to the lifetime exemption to see whether or not we owe estate tax. Appreciated assets, as we have said before, appreciated assets are treated differently if they are given as a gift versus left as part of an estate. If it is a gift, the recipient uses the same basis as the giver. Remember, that's that carryover basis. If the assets are part of an estate, the recipient gets a stepped up basis equal to the fair market value of that asset at the date of death, or 6 months after the date of death if the executor elects it, but we'll just assume the date of death to make it easy. What this means is it is usually better to leave appreciated assets as part of the estate rather than giving them as a gift. So let's look at an example. Matilda owns 1,000 shares of stock in XYZ Corp that she purchased in 1983 for $10 per share. In 2025, the stock is worth $500 per share. Matilda then either A, gifts the stock to her son Matthew in 2025. Matthew then sells the stocks for $500,000. His basis is $10,000, and he must pay capital gains tax on $490,000. His capital gains tax rate is 20%, and therefore he owes $98,000 in tax on the sale of that stock. Or B, Matilda dies in 2025, leaving the stock to Matthew. Matthew sells the stock for $500,000. Matthew's basis in the stock is $500,000, and therefore he owes no tax on the sale. So $98,000 saved because the stock was left as part of the estate rather than as a gift. Now let's talk about tax planning. Of course, we have talked about tax planning throughout this series. When we talked about education credits, even choosing a filing status, all of that estate stuff that we just talked about, planning appreciated assets, give them after death rather than before death. So there's lots of times when we've talked about tax planning, but there are some other topics that we do want to go over specifically for the exam. We want to talk about these three areas: tax projections and estimated payments, income and deduction timing, and then investing to save. Projections and estimated payments. As we said in a previous video, if significant income comes from sources other than wages or retirement payments for which there is withholding, you should, preferably quarterly, project income, deductions, etc., for purposes of making estimated payments. So I'm sure you've already memorized these dates, but those estimated payments are due April 15th, June 15th, September 15th, and then January 15th of the following year. So you'd like to sit down, hopefully every quarter, and do these projections. You can use these projections not only for making estimated payments, but you can use them for other planning purposes. So these other things we're going to be talking about, you can use these projections for doing that. Some of the things we've already talked about in these videos, it's going to be helpful to have projections done. So as you're going throughout the year, you can be thinking about what do we need to do before the end of the year. So now let's talk about income and deduction timing. When you're doing those projections, this is one of the things you want to think about. So you want to look at your estimated income and deductions in this year and next year to see which year would be most beneficial to include income or expenses. Because you often do have some flexibility in including some amounts in income and when you pay for certain expenses in order to take deductions. Now, remember constructive receipt. You can't just hold on to some money in one year and wait to deposit it into the next year in order to put off paying taxes. But there are other ways that you can have some flexibility that we will talk about. So the classic strategy is to accelerate deductions into the earlier year and to postpone income into the later year. So as a general rule, it is better to pay taxes later rather than sooner. Now, of course, there can be circumstances where this does not apply. For example, if Congress comes and passes a new higher income tax that takes effect next year, then you might want to try to include the income this year rather than next year. But as a general rule, assuming that the tax rates are staying the same, it's better to pay the taxes later rather than sooner. You also want to consider items that are affected by those AGI thresholds that we've talked about through this course. So when you're making IRA contributions, remember whether or not you can make the contributions or whether or not they are deductible is going to depend on your adjusted gross income. So you want to think about that when you're trying to decide which year should you have your income and your expenses. You've also got AGI thresholds for child tax credits, for the student loan interest deduction, and then when you're looking at passive loss deductions from active participation in rental real estate that we talked about before, that also could be affected by your AGI. And there were lots of other places where AGI became a factor as well. So you want to think about that as you are doing your planning. Capital gains and losses. If you have a lot of capital losses this year, it might be worth selling an appreciated asset now, since the gain on that sale would be at least partially offset by the capital losses. So remember, you're limited to that $3,000 each year of capital losses. So if you've got a lot of capital losses that you're not going to be able to take this year, and you've got an asset that's sitting there that if you sold it would produce a big capital gain, this might be a good time to sell it. Because if you sell it now, you'll have all these capital losses to offset that gain. Now, don't get me wrong. I'm not saying that you should make your investment decisions based solely on tax consequences. If that's an asset that you want to hold on to, or that your client wants to hold on to, they think that, yes, it's worth a lot now, but I think it's going to be worth even more in the future, then they should just hang on to it. But if they've got an asset that they're thinking about selling, that they're on the fence about, this is something you might consider doing. On the other hand, if you do not have any capital losses to offset that gain, you might be better off waiting to sell it until next year. So if it's December and they're thinking about selling it, if they don't think there's much risk that the value of that is going to drop before January, they might be better off waiting just to sell it in January. That way they don't have to pay tax on it until the following year. Also, if they have appreciated assets, they might consider donating them to charity because remember, as we said, you get the deduction for the full fair market value, but you do not have to pay any tax on the gain that is built into that asset. So what are some ideas for timing this income and deduction? Well, you can take distributions from retirement accounts in the year that benefits you the most. So if you've got one of those taxable retirement accounts, you can mostly decide when you want to take the money out of that account. You can take it out this year, you can take it out next year if you want to. Now you could have, of course, required minimum distributions if you're age 73. But above and beyond that, you have the flexibility to determine when to take the money out. And so when you're doing your planning, you can decide which year would be best. Of course, you've also got those qualified charitable distributions that you can make to avoid tax on the distribution. And if you own your own business, you've got a closely held corporation, you can take your salary and bonus in the year that is most beneficial. Now, when we get to part 2, we're going to talk about reasonable compensation. You do have to pay yourself reasonable compensation during the year, but you still have got some flexibility here. What a lot of business owners will do, for instance, is they'll wait till the end of the year, see how the business did, and decide whether or not to take a bonus for the year. Well, they can choose to take that bonus this year or to wait until next year. So that's another area where they've got flexibility to decide when to include that income. And then there's also something called itemized deduction bunching. So, to the extent that you can control when you pay for your itemized deductions, you can bunch them into 1 year to maximize them. So, if you're thinking about making charitable contributions, you can try to make them all in 1 year rather than part in 1 year and part in the next. Or medical expenses. You can choose to put off an elective procedure till next year instead of this year, or you can have the procedure done, say, in December. The bill won't come due until January and you can pay it next year. So the standard deduction these days historically is very high. So what you might do is say, okay, let's get as many deductions as we can into 1 year and we'll itemize deductions. And then the next year we'll take advantage of the standard deduction. So that's the types of things you can do with itemized deduction bunching. Our next tax planning idea is to invest to save. So you can make contributions to any of the following accounts in order to save money on your taxes: employer-sponsored retirement plans, IRAs, HSAs and FSAs, 529 plans, Coverdell ESAs, and ABLE accounts. So we'll talk about each of these. For employer-sponsored retirement plans, so this is like 401k, 403b, 457 plans, or a thrift savings plan for the federal government, you can contribute up to $23,500 per year for 2025. That amount does go up each year. If you are age 50 or older, you can make an additional $7,500 catch-up contribution for a total contribution of $31,000 for the year. And then this is new for 2025. If you are age 60 to 63, you can make an additional $11,250 super catch-up contribution in lieu of that $7,500 contribution. So instead of a $7,500 catch-up contribution, if you're age 60 to 63, you can make an $11,250 catch-up contribution for a total contribution of $34,750. Do remember that contributions can be up to 100% of your compensation. So, for example, if you earn $20,000, your contribution is limited to $20,000. So, it's going to be the lower of your compensation or your annual contribution limit. Also, with these retirement plans, employers often match part of your contribution. That match is also tax-free, which makes these accounts even that much more attractive. And for lower income taxpayers, lower income taxpayers may be eligible for the Savers credit for amounts contributed to their employer retirement plan. Next are SEP and simple IRAs. So these are going to be IRAs that are set up at an employer. So first is a SEP, a self-employed pension. So the business can contribute up to $70,000 or 25% of compensation, whichever is less. There are no employee contributions or catch-up contributions. But if you've got your own business, you can set up a self-employed pension plan, and then you can contribute, or the business can contribute, up to that $70,000 or 25% of compensation, whichever is lower. For a simple plan, the Savings Incentive Match Plan for employees, this is one that the employee makes contributions to. They can contribute up to $16,500 in 2025. If they are age 50 or older, they can contribute an additional $3,500 for a total of $20,000. And again, new for this year, if they're age 60 to 63, they can contribute an additional $5,250 for a total contribution of $21,750. And the Savers credit, again, can be available for these plans. Then we've got IRAs. We did a whole video on IRAs, but just to recap, you can contribute up to $7,000 per year, $8,000 if age 50 or older, and that is the total contribution that is allowed for the year for all of your traditional and Roth types of plans. And again, you can get the Savers credit if you qualify. Next is the health savings account, or HSA. This is a pre-tax savings account for healthcare expenses. And then the distributions that are used to pay for qualified medical expenses come out tax-free. So you get a tax deduction for putting the money into the HSA, and then you do not have to pay taxes on the distributions when it comes out of the HSA. What this does is it effectively makes your healthcare expenses totally tax deductible. In order to make this tax deductible contribution to an HSA, you do have to have a high deductible health insurance plan. What does high deductible mean? Well, if the insurance is just for you only, the deductible has to be at least $1,650 for the year. If it is an insurance plan for your entire family, which could be just you and your spouse, or it could be you and your children, or you, your spouse, and your children. But in any case, if it's more than just you, then the deductible has to be at least $3,300. Those are the deductible amounts that are required on your health insurance. How much can you contribute to these? If it is self-only coverage, your maximum contribution for 2025 is $4,300. If you are age 55 or older, not 50, but 55 or older, then it is $5,300. If it is family coverage, then your max contribution is $8,550 or $9,550 if you are age 55 or older. And this is not a use it or lose it type of plan. You can contribute that money. If you don't use it, then it rolls over from year to year. And if you still have a balance in that account at retirement, then it acts just like a traditional IRA. So the HSA really is a good way to save extra money every year. So if you're meeting those caps for your IRA contributions, for your employer plan contributions, and you want to put more money away, max out your HSA. You can either use it for medical expenses, not have to pay tax on that money, or you can take it all the way to retirement, and then you have an additional IRA. Next is a flexible spending account. So this is an employer-sponsored pre-tax savings account for healthcare expenses. The maximum contribution in 2025 is $3,300. This is a use it or lose it. So generally, you must spend all of the money by the end of the year or you lose it. So you want to be a little careful about how much you put in there. If you don't think you're going to spend $3,300, you don't want to put $3,300 in there. Now, there can be exceptions to the use it or lose it. If the plan allows, they can offer a grace period of 2.5 months to use the funds. In other words, they can allow you to use those funds by March 15th of the next year. As an alternative to that grace period, the plan might allow up to $660 to be used at any time during the following plan year. So the general rule is have to use it by the end of the year, but the plan can have one of these alternatives as part of it. One advantage of the FSA over the HSA is that with the flexible spending account, you do not have to have a high deductible health plan. You can have just a regular health insurance plan with normal, lower deductibles and still contribute to an FSA. Next is a dependent care FSA. So this is the same idea as the flexible spending account, except instead of using it to spend for healthcare, you are using it to spend for dependent care expenses. The maximum contribution is $5,000 or $2,500 if you are married filing separately. Now that can be reduced for certain highly compensated employees. So if they have earnings of greater than $160,000, instead of getting $5,000 as your maximum contribution, that can be reduced to either $2,000 or $2,500, depending on the circumstances. But mainly for the exam, what you want to remember is this $5,000 number. And just like the healthcare FSA, this is a use it or lose it type of account. Next are 529 plans. These are also called a qualified tuition program or QTP. We usually just call them 529 plans. They are plans that are set up to provide for the education of the named beneficiary. So often parents or grandparents will set these up for their child or grandchild. Contributions to these plans are not tax deductible, but they grow tax-free, and distributions are tax-free as long as they are used for qualified education expenses. So they can be used to pay for higher education expenses, so college, tech school, after high school, including tuition, books, fees, equipment, and reasonable room and board. It used to be that's all they could be used for, but now you can also use them for up to $10,000 per year of tuition for kindergarten through 12th grade, but it is only for tuition. However, there is a new provision from the OBBBA for 2025, but it is only for distributions after July 4th of 2025. In that case, for these K through 12 beneficiaries, the money can also be used not just for tuition, it can also be used for curricular materials, books, online materials, certain tutoring, fees for standardized tests, dual enrollment in college classes, and educational therapies for students with disabilities. So again, that piece, the non-tuition piece, is only for distributions after July 4th of 2025. Funds from the 529 plan can also be used to pay off up to $10,000 in student loans. But if you take the money out of the plan for any purpose other than qualified education expenses, then they are subject to income tax and a 10% penalty. With 529 plans, there is another new provision for 2025. In addition to higher education expenses, certain post-secondary credentialing expenses are considered qualified higher education expenses for 529 plans. This includes tuition, fees, books, supplies, and equipment for a qualifying credential program and the fees to test for and obtain the credential itself. It also includes continuing education required to obtain or maintain a qualifying credential. There are specific requirements for what is considered a qualified credential, though I will tell you that the definition is quite broad. So it is going to include most of the credentials you can think of, including, by the way, the EA and CPA credentials. So if you have one of these 529 plans, if you are a beneficiary of one, you've got funds that are in there. You can use those funds to pay for your fees for taking the EA exam, for preparing for the EA exam, for continuing education for the EA credential. Again, though, this is effective only for distributions made after July 4th of 2025. Next is a Coverdell Education Savings Account, or ESA. It's also known as a Coverdell IRA. Contributions are not tax deductible, but they do grow tax-free, and distributions are tax-free when they are used for qualified education expenses. Can be used to pay for kindergarten through 12th grade and higher education expenses, including tuition, books, fees, equipment, and reasonable room and board. Contributions are limited to $2,000 per year per beneficiary in total, no matter who makes them or how many accounts are set up. And they are subject to a 6% excise tax for excess contributions. So it can be easy if you've got multiple people who are contributing to go over the $2,000 per year maximum by accident. So it's important as soon as you find out that there has been too much put into one of these Coverdell IRAs, that you get that money out as soon as possible. Otherwise, it is going to be subject to this 6% excise tax every year until those excess contributions are withdrawn. And then no contributions can be made once the beneficiary is 18, and the balance of the account must be distributed in total by the age of 30. Contributions are phased out for the givers with AGI over certain levels. So if you've got over $110,000 of AGI, you cannot make any contributions. Under $95,000 of AGI, you can give the full $2,000, and then it is phased out between $95,000 and $110,000 of AGI. those AGI limits are doubled for married filing jointly taxpayers. You can make contributions all the way up until April 15th of 2026 for the 2025 tax year, just like an IRA. And if the money is withdrawn for any reason other than paying for qualified education expenses, there is tax and a 10% penalty. ABLE accounts. So these are Achieving a Better Life Experience account. They are sometimes called a 529 Cap A account. They are set up to provide for the qualified disability expenses of the beneficiary. Contributions can be made by the beneficiary and by others, and amounts can also be rolled over from a 529 plan as long as the total contributions are within the annual limits. So you may have had a 529 plan set up for this beneficiary when they were young, and then unfortunately that beneficiary became disabled. So you may not be using those funds to pay for higher education, but you can roll those over into this ABLE account. The annual contributions are limited to the annual gift exclusion amount, which for 2025 is, of course, $19,000. And that is contributions from all sources, from all people. Having said that, the beneficiary themselves may be able to contribute additional amounts over that $19,000. So the amount that they contribute is up to their total compensation or the poverty line for a one-person household, whichever is less. This is only available if the beneficiary does not participate in an employer retirement plan. So if that beneficiary is able to work, they can take part or all of their compensation and contribute it to their ABLE account. It's just that the maximum they can contribute is going to be the poverty line for a one-person household. The beneficiary's contributions to this ABLE account are eligible for the Savers credit as long as they otherwise qualify. The contributions are not tax deductible, but they do grow tax-free. And as long as those distributions are used for qualified expenses related to the beneficiary's disability, those distributions are tax-free as well. And that, my friends, is the end of video 7 and of part 1 individuals. Congratulations and good luck on the part 1 exam. Study the slides, watch the videos again as needed, and I will see you in part 2.